Joining us now, Ben Harris, the Director of Economic Studies at Brookings, and Michael Strain, Director of Economic Policy Studies at the American Enterprise Institute. Mike, let me start with you about this issue of how afraid should the Fed be of cutting too early and having a return of inflation like we had in the 70s?
Steve, I think it's a great question. The case for being concerned is as follows. The labor market is still very, very tight.
Right.
Labor demand is still in excess of labor supply. Labor demand is still way in excess of what we thought in 2019 was a lot of labor demand. We have 9 million job vacancies right now. In 2019, we had millions fewer and thought that we had quite a bit of labor demand. Potential GDP is likely lower than actual GDP will be. So not just the labor market, the economy overall likely will be running hotter in 2024 than its underlying potential. Services inflation is slowing at a much slower pace than overall inflation. So we have a services inflation problem. Wage inflation is slowing at a much slower rate than overall inflation. So wage inflation is still inconsistent with the Fed's target. And most importantly, the market is reacting to the Fed's communication strategy, the Fed's decision at the last meeting, by going gangbusters. And so what the Fed wants to do is to tighten overall financial conditions. Overall financial conditions, by some measures, are looser today than they have been in 2 years. The market is expecting many, many cuts in 2024. And so all of this, I think, should make the Fed concerned that inflation, if it doesn't rebound, it might just kind of get stuck at the 3% level it currently is, which is, of course, much higher than the Fed's target.
Just to fill in some of the data that Michael was talking about, in 2020, before the pandemic, 6.7 million job openings, and now it's 8.7 million. So, Michael, it was like a cold stream of cold water all over the optimism of this market, Ben. Do you want to try to restore the optimism of rate cuts, or do you want to pile on, Ben?
So, Steve, I think I agree with what you said at the outset, which is I think markets shouldn't be so quick to assume the Fed is going to cut. I mean, I look at this Fed and I see a group that's dying to pause and doesn't want to hike and doesn't want to cut unless it is absolutely forced to. Now, if we get 3 months of really strong inflation data, the Fed's going to have to cut in March, and they'll cut by 25 basis points. But it's going to take some pretty sharp declines in core PCE for that to happen. Now, they did show in their summary of economic projections in December that they are expecting over the course of the year core inflation to fall by about 80 basis points, which is a lot. But that has to happen in order for the Fed to cut. So I think we're kind of in a pause unless the data forces you out of that pause type of moment right now.
Ben, let me stick with you. Give us your best outlook for next year. Is it crazy to think that the Fed lands this plane? We have a soft landing. We keep unemployment low, GDP at potential, and we just go about our merry business in 2024?
Yeah, I mean, this economy right now is like the definition of a soft landing. Unemployment's at 3.7%. We've had this gradual moderation in the labor market. That's something we've almost never seen. You saw labor market tightening not because of easing in the tightness in the labor market, not because of raising unemployment, because more people are coming back to the labor market, which is a great thing. You're seeing strong consumer spending, household balance sheets, except for those at the very bottom, are still in really good shape. So I think there's a ton of reason for optimism. My base case is for slow but positive growth over the course of the year, which is consistent with the Fed. I just don't think there's much reason to think that we'll see a recession the next year.